Hello there. Welcome to the most exciting part of this course. Here, we will implement all we've learned so far in a business context. Contrary to what we've examined so far, time series analysis isn't all about forecasting. Instead, we can apply a in retrospect approach to the data to see how time variant patterns change as new data is added. In this business case, we'll try to analyze the data leading up to the Volkswagen buyout of Porsche. We'll compare what models describe the stock best before and after each announcement and comment on the results. Additionally, we've defined another crucial date in the history of Volkswagen, the so-called start of the Dieselgate scandal in September 2015. As a homework exercise, you'll have the chance to examine how this scandal affected prices, returns, best-fitting models, as well as volatility trends. Now that we've set the expectations, let's get coding. For your convenience, open the template file attached to this lecture. In it, we provided the code for all the relevant models we'll be using, so you can simply run the cell instead of typing them out one by one. Next up, it's time to import the data. Just like we did in the previous two sections, we're going to directly scrape the data off Yahoo Finance instead of importing a fixed data set. Please be aware that unless you specify this initially, the code will automatically import all the available values up to today. Okay, so the only argument you need to provide are the tickers. As you know, these are the abbreviations for certain equities on the stock market. You can open up Yahoo Finance and look up the names for the Volkswagen and Porsche equity stocks we're interested in. The ticker names for them are VOW3.DE and PAH3DE, respectively. Of course, the DE at the end indicates that this data was recorded from the German stock market. As you know, there are other markets where these stocks are exchanged, but choosing the German one makes the most sense since both companies are German-based. To make sure all the changes in value are stock-specific, we need a market benchmark. Ideally, this would be some other automobile producer selling stocks on the German market, so BMW seems like an obvious choice. Thus, we add BMW.DE and run the cell. We see that 3 of 3 datasets have been downloaded, which is exactly what we wanted. Let's also create copy datasets, which we will call DF, and work with throughout the lectures. Right. Next up, we need to define several very important dates in this specific business case. The first one is start date, which we set to the 5th of April, 2009. This is the earliest date that we have recorded values for both stocks. The next date is the first announcement, which occurred on the 9th of December, 2009. On that day, VW announced they own 49.9% of Porsche. Then, we have the second announcement on July 5th, 2012, when VW announced the purchase of the remaining 50.1%. That means they have full ownership of Porsche. So, we expect their values to move quite similarly after this point. After that, what we wish to specify is the end date one. Since the period from the second announcement until today is far longer than those in between, we need another date. For us, January 1st, 2014 seems reasonable enough, but feel free to deviate if you wish to. Lastly, we need a date for the Dieselgate scandal. Even though we won't be using this in the lecture, it's convenient to define it early on since you'll be using it for the homework exercises. Okay. After that, we need to store the closing prices of each stock as new columns of the dataset. We can call these columns Vol, POR, and BMW, respectively. While we're at it, we can also create the returns for each stock as well. If you recall, we applied the percentage change and multiply commands to get these returns. This should all be very familiar to you by now. In addition, we should create squared returns for each time series because we'll be examining the volatility of the equity stocks down the line. We should indicate these are squared values in the name of each column. Before we proceed with the pre-processing part, we also want to extract the number of purchases and sales each day. So we store the volume arguments of each ticker into new columns of the dataset. To separate these values from the regular price ones, we simply add a Q to suggest this is the quantity traded on that day. Of course, the more a certain stock is being traded on a given day, the more likely it is for its price to fluctuate. We wrap up the pre-processing process by setting the frequency, taking care of missing values, and removing any surplus columns. In this case, we can get rid of entire tickers because we've already stored the values we need in new columns. At this point, we usually split the data into a training and a testing set, but we're not doing that here. We don't need to do so because we're examining a specific event in time rather than trying to predict the future. All right, now that we've set everything up, we can plot the data to see how the three time series move over time. Make sure to specify what color each time series is to avoid misinterpreting the results. We see some similarity in the way they move, which indicates trends of the entire automobile industry market. However, VW prices shift a lot more in magnitude after the third quarter of 2009. To get a better idea of what's really happening, we should separate the different intervals by color. If every period of every time series is random color, we'll probably get an eyesore. So we'll switch with varying tones of the same ones instead. More precisely, we'll be going from lighter to darker shades of the same blue, green, and gold colors we chose earlier. Of course, that would require plotting the different intervals separately, so we would first need 3 different plots for each stock. To make matters simple, here are the hex codes for different shades of both blue, green, and gold we'll be using. As a bonus, we're also adding a legend to the plot so that you don't have to look at the code to tell which curve corresponds to which stock. Prior to the first announcement, we see that the two stocks, VW and Porsche, move in a similar fashion. However, Volkswagen's numbers seem to be roughly twice as high. Afterwards, the gap between the two seems to grow bigger and bigger. If we look at BMW's numbers, we'll see that they resemble the Porsche ones much closer than the VW ones, or at least that's what it looks like at a glance. To get a better idea of how similar each one of these series is to the others, we should examine their correlation. To achieve this, we simply need to call the correlation method on one series and add the second one as an argument. That means we're going to have 3 different values rather than 6, since the correlation between Volkswagen and BMW is the same as the one between BMW and Volkswagen. As you know, we should use the print command if we want to execute all the outputs in a single cell. To illustrate better the values representing each correlation, we're going to add some clarifying texts and use tabs to align the numbers. One last thing to remember, we're currently only interested in the period between the starting and ending dates we set up earlier. So make sure to specify that as well. Interestingly enough, we get a much higher correlation between BMW and Volkswagen prices than between Porsche and VW. This suggests that VW moves in a similar way to the market benchmark, albeit in much higher values. But wait, VW owns 100% of Porsche by the end of this time interval. Shouldn't the correlation be much higher? To understand what's really going on, we need to pop the hood. We do this by examining the 3 different intervals one by one, starting from the earliest one. The only change we make requires changing the end of the interval variable. We see much lower correlation all around, with the Porsche and BMW value taking the biggest hit. This suggests that the stock prices for these brands weren't too similar before the start of the buyout. A possible explanation for this is the following. Porsche's evaluation becomes heavily tied to that of Volkswagen. Then Volkswagen becomes a market trendsetter, so all other companies have to adjust to it. That way, VW affects both Porsche and BMW simultaneously, one directly and one indirectly. Then the pull of VW in times of boom makes it so that Porsche and BMW appear to change in a similar manner without a direct causal link between them. If this is indeed the case, then we expect that Porsche-BMW correlation keeps increasing as VW grows as a market leader. What's more, we expect the VW-Porsche interdependence to also increase as Volkswagen continues to buy Porsche shares. However, instead of speculating, we can test this by altering the start and end indices for the period we're examining and rerunning the cell. The new results show an increase across all correlations, which matches our expectations. The really interesting output here is the almost 98% correlation between VW and BMW. If we have another look at the graph, we can see that over that time period, VW stocks grow in value several times faster than the market benchmark. However, since the market moves relatively the same way, VW becomes a sort of trendsetter after the partial takeover of Porsche. But what happens after Volkswagen fully buys out Porsche? Well, let's change the interval values once again and find out. For once, we see a higher correlation between VW and Porsche than between VW and BMW. This goes to show that the two are truly being recognized as a single entity, and the prices of one directly affect the other. However, the highest correlation is the one between BMW and Porsche, which is interesting considering they have no obvious link between them. Okay, so if VW continues to be a market trendsetter, these correlations should all remain high, right? We can change the interval to include all the values from the ending date onwards. If we make this adjustment, we'll see that the correlation between Porsche and VW remains high, but the other two have fallen drastically. If there was another boom in the VW prices, it would once again lead the market with it. But this doesn't appear to be the case. So what did actually happen? The Dieselgate scandal, which picked up steam in September 2015. Without too many spoilers, this event hit Volkswagen much harder than BMW and Porsche. That said, for homework, examine how that event changes the correlation between prices and comment on your results. Now we examine the correlation, but what about our choice of models? If an event like a buyout changes the market significantly, what happens to the best fitting models? Well, these models are supposed to capture the current trend in the market, but if the trend shifts, then so should they. Let's examine how the VW trends change after the two announcements. To avoid going through the rigorous process of manually selecting the best model, we're going to use the Auto ARIMA method. Of course, we'll provide the BMW and Porsche prices as exogenous variables. A case can be made without omitting one or the other, especially in instances where we have a very high correlation, since they take away from the explanatory power of the lagged VW prices. Nevertheless, let's see what the best models are for all three periods. We can run the three Auto ARIMA lines in the same cell, but if we want to display the three summary tables simultaneously, we need to use the print command. However, doing so will output all the summary tables on top of one another, which can make it hard to distinguish which is which. Thus, we'll simply output them one by one in different cells. As you already know, the Auto ARIMA method can be sometimes quite slow to compute. If you're coding along, you can pause the lesson here to make sure you get the same outputs. So for the period prior to the 49.9% announcement, we see that an AR model with a single lag and two exogenous variables is the best fit. All coefficients apart from the intercept are significant, so this is indeed a good fit. We see that the estimate for the AR1 value is very close to 1. This means we're sticking really close to the value of the last period, with very little deviation. Of course, this isn't very surprising since we're using prices that don't oscillate completely randomly. Next up, we see that an Arimax 111 is the optimal choice after the initial announcement. This is a really big shift for two main reasons. First, the optimal model is an integrated one. Since Auto ARIMA enforces stationarity, we know that the new dataset is certainly non-stationary. Second, the model finds past residuals to have significant explanatory power. This indicates that the real-life announcement actually changed the trend for VW prices. Moving on to the last interval, we see that the model has changed completely one more time. We are once again recognizing the non-stationary nature of stock prices, but we're no longer relying on past values. Instead, we can see a huge shift toward the coefficient for Porsche prices. As you can presume, this shift occurs because the two automobile manufacturers are now a single entity. For this reason, The valuation for Porsche today will be a more accurate estimator than the price of VW yesterday. Therefore, we see that new information seems to have a higher impact on trends compared to past patterns. But is this the case only for VW as its purchaser, or will this hold true for Porsche as well? Let's quickly find and summarize the best models for each period of Porsche prices and see if the trend persists. Before you run the AutoArima, make sure to change the endogenous as well as the exogenous variables, since the roles of Volkswagen and Porsche are flipped. After you've done the necessary changes, run the code and examine the three new summary tables. Once again, we see a huge shift from one interval to the next. Before the first announcement, we see that an AR2 model with two exogenous variables is the best fit, which is similar to what we had for VW over the same period. After the first announcement, we see a shift toward an integrated model. This directly translates into a roughly 1-point drop in the AR coefficient, from 1.08 to 0.07. Of course, this isn't too odd, given that we're using integrated values here. However, an additional explanation comes from the rise of the VW coefficient, which now has a bigger impact. The direct jump from 0.12 to 0.19 might not seem immense at first, but it's actually a relative jump of more than 50%. Going to the third summary table, we once again see a huge shift. Interestingly enough, this time the model discovers a seasonal pattern, which we haven't encountered before. This backs up our notion that these trends are affected more by current events rather than pre-existing patterns. Great. We just examined two cases where we see major trend changes occurring after new information is introduced. However, we were using the same type of non-stationary prices for both. So for homework, reenact the same analysis using returns instead of prices and check how the models change. Right. We talked about how these events change the correlation and the general patterns within a data set. So let's see how they change predictions. We're going to take the best fitting models and forecast them into the future. Then we'll compare the predictions based on data before the announcement to the actual values following it. We'll do this for the first purchase announcement on the side of Volkswagen, and we'll leave it up to you to do the same for the second one and the Dieselgate scandal. Let's start by trying to make predictions for the time period between the two announcements based on the trend prior to the first one. Of course, we're going to use the AutoArima method again, but we'll loosen up the restrictions a bit to ensure a better fit. For the time being, we won't include either of the other time series as an exogenous variable. Next up, we're going to create a new column of the data frame where we store the predictions for the Volkswagen prices. We'll set it equal to a data frame with values equal to the predictions for the period between the two announcements and use the indexes of the dataset for that same period. Afterwards, all we've got left to do is plot the new column over the period from announcement 1 to announcement 2 and compare the values with actual Volkswagen prices during the same interval of time. We'll also add a title to make sure we know what we're looking at. All of this should be very intuitive, so we're just going to get right down to the results. At first glance, the predictions seem very good over the first 3 or 4 months, but then start to die off faster and faster, while the actual prices steadily bounce right up. This indicates that the announcement didn't make a great shift in price trends for VW initially. That can be attributed to the market lags, where new information as well as policy changes take a while to respond appropriately. That being said, we notice that the forecasted prices are going down below zero, which is impossible. This should be a huge red flag showing that this trend isn't sustainable long term. But how is there such a huge rift between the close predictions in the first quarter after the change and the time onwards? Well, let's zoom in and examine the period up to the first quarter 2010. We see that the predictions weren't really close day by day, but captured the general trend over the entire period. This means the predictions would only be useful if we were trying to ballpark the quarterly performance of prices. Okay, so what if our model included exogenous variables like the Porsche prices or a market benchmark like BMW prices? Let's find out. We'll start by adding Porsche prices. Since we're still predicting values over the same interval, we can reuse the code we already have and just add the exogenous variables. But make sure to add them both to the AutoArima method and the predict method, otherwise we're going to get an error message. Right. Now we see a trend that doesn't simply die off exponentially after several months. Instead, values fluctuate within some reasonable range. However, after some time, we see that the general trend and the lower Porsche prices lead our forecasts astray. Therefore, adding Porsche prices improves predictions, but not substantially, since we're moving far away from the actual values after Q3 of 2010. Since Porsche is partially owned by VW at that point in time, using a market benchmark would probably be the wiser move. So try switching the exogenous variable to BMW. With this small alteration, we can see that the forecasts are finally lining up with the general trend over the entire period, rather than only the first few months. However, we see that the changes our forecast makes are more conservative for both rises and falls. In some intervals, failure to adjust to a major decrease results in overestimation for a prolonged period. The same holds true for great jumps occurring in Q3 of 2010, where our forecast indicates some expected rise, but fails to truly capture its magnitude. Overall, these predictions resemble the real movements of the VW equity much better than the two previous models. That being said, let's see what happens if we include both exogenous variables. To do so, just specify we're also taking Porsche prices in the AutoArima and predict methods. After plotting the new predictions, we see that the new forecast is now similar to the one using only BMW prices. However, this one matches the smaller shifts better and adjusts to big jumps and drops faster. Thus, by adding a relevant value to the market benchmark, we can once again improve predictions significantly. Therefore, we can confidently say that max models are less affected by real-life events because the other time series often reflect the changes in the market and help navigate expectations. However, we saw that the general trends changed after the first announcement, even though it took some time for the prices to reasonably shift in an unpredicted manner. For practice, you can rerun this code for the second announcement and the Dieselgate scandal and check the results. The only change you need to make involves changing the interval lengths for many of the variables. Okay, now that we've seen how the introduction of new information can alter our predictions, let's have a look at volatility. Usually, we expect some major shifts surrounding such events. A quick side note, we say surrounding rather than after, because, as you know, rumors and speculations fuel market trades. We've already discussed how squared returns represent the volatility of a stock, which is why we compiled the associated values for all the different automobile manufacturers. Now let's have a look at their instability. We see that Volkswagen has the highest volatility before any of the announcements. This is fascinating because the stock becomes extremely stable following each of the two announcements, while it exhibits instability in the time leading up to each purchase. Such behavior can most certainly be attributed to the rumors spreading across the market about a deal on the horizon. However, since Porsche had initially tried to purchase VW a few years back, many people weren't certain of how it would all play out. We know a simple Garch 1-1 model should be the best fit for returns, so let's see how the variance and residual term coefficients evolve from period to period. We can do this by fitting such a model for every period and comparing the values from the summary tables. Once again, this is something you know how to do, so we're not going to spend a lot of time on it and move straight into exploring the table values. For the first one, we immediately see a p-value of 1 for beta 1. That means the trends in variance aren't as persistent as we would expect, so there's no need for a Garch component, and a simple arch model would probably work better. In the second table, we see the exact opposite, a p-value equal to 0. This means the autocorrelation in the conditional variance is significant and hardly dies off based on the coefficient value. The significant constant, mu, indicates that there's some constant trend in the returns values. Additionally, the significant coefficient for omega suggests the exact same feature can be found in volatility as well. Simply put, we never expect returns or their volatility to ever be perfectly stable. which is normal for a market lacking efficiency. In the third table, we see non-significant coefficients for the constant omega and alpha 1. This implies that there is some autocorrelation in volatility, which fits the volatility clustering feature. However, since the entire interval is much more stable, even the beta coefficient has dropped by roughly 1/3. Overall, we see really different volatility trends in all three periods, which is quite intriguing. The purchase of Porsche has led to the death of many rumors and provided VW with a larger share of the market. This in return has resulted in much lower volatility after each announcement, making VW stocks a more appealing prospect. For homework, examine the volatility of Porsche during the same interval of time. Do either of these announcements bring stability, or do they bring uncertainty? In addition, examine how VW's volatility changes around the Dieselgate scandal in September 2015. Then comment on the value changes and compare them with the market values. And if you want a little extra practice, you can also examine the number of stocks traded on a given day by plotting the volume of each brand, which we stored in the Q columns of the data frame. Well, that was our business case study. We've answered some interesting questions and opened up even more. To be honest, it's much more fun and useful to explore the hidden trends and patterns on your own. That's why we've left the bigger chunk of the work for homework. I'm sure you'll do great, and congratulations. You've also reached the end of this course on time series analysis in Python. Over several sections and a few hours of video, we've learned all about the most widely used time series concepts. We understood what white noise is and how a random walk behaves. We discovered what separates time series from cross-sectional data and what stationarity and seasonality means. Furthermore, we learned how to import a data set or scrape it off Yahoo Finance before transforming it into a time series. We did the latter by defining the frequency and setting the dates and indices. We then went on to learn some of the intricacies of time series data, what autocorrelation is, and how we can use the ACF and PACF to our advantage. We learned how to use and implement AR, MA, ARMA, ARIMA, Arimax, Sarimax, AutoArima, Arch, and Garch models. I believe that you have all the tools to feel much more confident when working with time series. With a heavy heart and lots of sorrow, I've shown you every Python trick. Good luck with all you do tomorrow. Your favorite online tutor, Vic. Oh, and thanks for watching.